This could absolutely be one of the biggest plays over the next quarter, quarter and a half. It's a small to mid cap tech name. We've stayed out of tech for the last month, but we do think it's time to start easing back in. It's a potential stage 2 breakout. And if you stick around to the end of the video, I will give you the exact trade that we are taking inside of TTI so you can follow it if you want. Let's go ahead and start here with Koifin and look at sector strength. Let me show you why we kind of want to start easing back into growth. We took off essentially the entire August period of growth, right? We sold our tech, communications, and consumer discretionary back in the 3rd or 4th week of July. Go back and watch the recent content that we put out about 3-4 weeks ago, and you can kind of figure out why we saw the sector rotation coming from a mile away, out of growth and into value, and we were able to successfully stay out of growth, tech, etc. over the course of the entire August trading month. And now we're starting to see a little bit of a resurgence here. And what I want to point out is there is a strong possibility that we bottomed on that August 17th, August 18th area on the indexes. And with that, growth has an opportunity to really start outperforming again. Value had about a 4-week period of outperformance. I don't know if it's safe to say that growth is going to start outperforming value yet, but we are starting to see a resurgence. And on the 1-month chart, tech has reclaimed up and over SPY, and we only want to be long things that are up and over SPY for opening up new positions, right? So first things first, tech here, consumer discretionary, these things are starting to outperform SPY on the 1 month, and that's our first real indicator. Hey, maybe we should start paying attention to this stuff again. And in particular, we look at SPY as the base here. People want to start longing semiconductors, that's fine, but I'd prefer to start longing software names. Why? Because software names are showing greater relative strength in the market than semis. They're up over the last month 0.28, whereas semis are not only under SPY, but they are down 2.54. So if you're looking to start gaining exposure back into the growth space, I do think that tech, and in particular the software space and the internet space, FDN, are two better spots to start allocating capital. But in particular, I like software. Right? We can take it one step further and we can kind of look at how market caps have worked over the last month here. I want you to consider that mid-cap growth, which is where we're going with this trade idea, is only down 0.43% against SPY. Now, it's important to understand normalized performance against the S&P 500. This is not absolute, but if you look at everything as a whole, mid-cap growth has held up very, very well over the last month. It has not died off like small cap growth that you see down here. These are your under $2 billion market cap type of names. We're looking at mid-caps right now, which is what we are going to talk about right now. By utilizing our scanners, which I'm not going to go through right now, we actually came up with this ticker, COUR, and this should look like a damn near home run incoming here. I zoom out and show you, it was just recently listed back in 2021. This is a patented stage 2 breakout, right? This is a potential wyckoff accumulation area base breakout. If you don't know what that is, check the link in the description below. I put out like an 18 to 20 minute video on helping you read these wyckoff market model ideas, the Stan Weinstein style stage 2 breakouts. It will absolutely help you in trading. I'm not going to go too far into it, but essentially we had the listing followed by a markdown, followed by a prolonged accumulation base, and this is what we want. We want a prolonged accumulation base, a horizontal channel with a defined overhead resistance area, and we got it at around 1675. If we look at how long this base actually played out, this was over a year, 474 days. So while everything else in the market during the bear market was going down, for whatever reason, COUR was going sideways. That's called relative strength. That's called accumulation. We can actually confirm that with the VRVP indicator. Look at how much volume was going on underneath 1675 and around above $10. There was a lot of shares changing over hands, right? Smart money was accumulating this position. We're above the 200-day moving average right now. Not only that, but it's sloped up. Two things that we absolutely love inside of TTI. We want to be buying strength. Typically, stocks trading above the 200-day moving average are going to continue to go up. Things that are moving below the 200-day moving average, better odds of it going down. So this is great on a bullish breakout that the 200-day moving average is confirming the longer-term trend. It's above a 3% ADR, which we absolutely love. There's going to be enough intraday volatility to make this trade worth our time. Bullish momentum regime on the RSI. We're consistently trending above the 50, which we absolutely love. It shows that bulls are in control here. And once again, the VRVP has a low volume node above the horizontal level break at that 1675, meaning there's probably not going to be a whole lot of resistance on the way up towards our price targets. So our entry here is 1675. Our take profit is the 1.618 area at that $21 spot, and the stop is anything below 1525. So how would you read this? You want to be long this stock above 1675. You want to be out of this stock if it closes below 1525, and you want to try to hold the stock until at the very minimum it hits 21. So how would we actually play this? Well, you could play shares if you want. It's not bad at a 3% ADR. There's nothing inherently wrong with playing shares here, but there is an awesome opportunity on the chain. Let's go ahead and look at this chain on COUR. Let's go to January. You have 141 days out, so there's plenty of time on this. That's the best part. 48.3 IV with a 17.3 IV rank means that there is higher probability shot of IV expansion than contraction, which means we're going to be going calls, not call debit spreads. It's a cheap play, and IV is in our favor to go straight calls. The $20 calls make the most sense to us because we're targeting that $21 area. We could go 22.5s, but there's not enough open interest for me to really say, man, I want this. But on those 20s, there's 1.74K open interest and a lot of volume on the day. I'm assuming some of that's from TTI TTI. So you're getting this trade exactly when we're taking it same day, right? So we started to get filled at around the $1. Some people got it 95. They're currently marking at 105. I think this is totally fine. As long as you're not buying upwards of $1.20, I think you're going to be totally okay. So anything under $1.20 on this play, and the reward to risk is still greatly in your favor. Obviously, the probability of infinite max profit is very low, right? But theoretically, the profit here is infinite. You're buying a straight call. There is no cap. Your max loss is the debit that you pay on the play. So whatever you put into the trade is going to be your max loss no matter what. Having said that, if you buy the $20 calls here, 141 days till expiration, 0.36 delta, we really like this play. What we want to do is we want to put, first off, a resting order on the books as soon as you get filled for double the price that you get filled at. So if you get filled at $1.05, you're going to want to put a resting order on the books to sell half of your open position at $2.10. What does that do? It completely removes any risk that you have in the trade in terms of capital in your account. You want to turn this trade free as fast as you can, meaning at 100% sell half. Let the other half continue to run to the overall profit target, which is $21. You're going to be in the money at that profit target, and you're going to have the flexibility to either close the entire position for whatever profit it's at, or continue to let the position run and then close out at your own discretion, depending on your own rules, because you do have 141 days to hold this. So once again, we want to be long COUR. This is a mid-cap software tech name breaking out into a stage 2 breakout, long above 1675. We want to stop on a close below 1525 with a profit target of 21, and we're going to utilize the January 20 calls, 141 days till expiration, 48.3 IV, 0.36 delta for anything under $1.20, right? Anything under $1.20, you get filled. Order immediately at double what you pay, cut half of the position, turn this thing free, and then manage it however you want. All right, guys, my name is Hamilton. I'm here with the Trading Initiative. These are the types of plays that we like to take. Everything is logical, and everything is based off of price and charts. Nothing is emotion. If you like this type of content, I'd appreciate it. If you'd like, subscribe. Leave a comment below. What do you think about COUR? Is it time to start buying growth? Should we still be worried? I will reply. I appreciate you. I'll catch you in the next video.